You actually give the money to the InvIT trust. The InvIT trust actually goes and buys, let us say, a road project, a road which moves from Mumbai to Nagpur, the Samruddhi Expressway. And what do they get? They get the concession right to actually levy toll on the traffic. So the decent returns could be anywhere ranging between 9 to 14%, depending upon which project they are putting. A retail investor has not invested in infrastructure asset. Even if you look at our own as a system, whole industry, but if you look at the percentage of investment made by the retail investor, it will be around 1.5 to 2%. They look at the distributions that has been given by the InvIT and mistake it for the return. The distribution is not equivalent to the return. The return is different, distribution is different. This gives you an yield of, InvIT gives you an yield of at least around 12 to 14. So for the risk that you are taking, you are actually getting a higher return than any other comparable instrument in the market.
India is entering one of the largest infrastructure investment phases in its history. Roads, power transmission, telecom towers, pipelines, warehouses, and renewable energy assets are expanding rapidly. But an equally important question is, how can ordinary investors participate in this journey? At Money TV, we believe informed investing begins with understanding how different investment vehicles work. That's why our commitment remains simple. Money TV, find true value here. Welcome to Market Pillars Uncovered, our special educational series where we engage with experts shaping India's financial markets and investment ecosystem. Today we're joined by Mr. NS Venkatesh, CEO of Bharat InvITs Association. With over 4 decades of experience across banking, treasury, international finance, risk management and capital markets, he has served in several key roles including CEO of AMFI, Executive Director and CFO at IDBI Bank, while also contributing to various RBI and SEBI committees. In today's episode, we'll understand how infrastructure investment trusts or InvITs work, where they fit within an investor's portfolio, the opportunities and risks they present, and how they are linked to India's long-term infrastructure development. Mr. Venkatesh, welcome to the show.
Thank you, Karinya, for inviting me to your show. It's a great privilege and pleasure for me to be a part of this show.
Likewise, and we're very excited to talk about a myriad of things, but we want to start from the absolute fundamentals.
Okay.
Now, for the benefit of our investors, if you can start by explaining what an InvIT is, how it works.
For the benefit of your members, I would say like this, that it is, we compare it like a mutual fund sort of a structure. It is more or less the same. In the sense, in the mutual fund, everybody knows about mutual fund in the sense that essentially you collect money from various set of investors. So it comes into a trust, and then the trust gives that money to an investment manager, that is a AMC, asset management company. And the asset management company manages that money by investing it depending upon the factors of the scheme in a mutual fund. Whether it is an equity-oriented scheme, so predominantly they will put it in equity, or if it's a debt-oriented scheme, they'll go into the debt. That is known as a pooled investment vehicle. So if you look at it from that angle, the same thing applies for InvITs also. InvIT also collects money from various investors and gets pooled into a trust, which is known as Infrastructure Investment Trust. And that infrastructure investment trust appoints an investment manager, and that investment manager will manage that money. So how does he manage? He uses this money to actually acquire infrastructure projects. Whereas in mutual fund, they use the money to invest it into financial assets like a equity or a debt, that's all. To that much extent, it is similar. What is different here is you have a project manager also.
Okay.
Whereas in a mutual fund, you don't need a project manager, you're already investing into companies and all. Here you are investing into real projects, like let us say a road, or maybe telecom tower, or a power transmission line, or a digital fiber, or a data center. So these are all real assets. It's not a financial asset, it is a real asset. Physical real assets which you can touch and feel. So you need a project manager to manage those particular assets to ensure that they are of the highest quality. So based on which you get the efficiency, the productivity and all those things. So the service level agreements that you would have entered into with the owner of that asset, you are able to meet that service level agreement, and you are getting the money by way of tariffs or toll. If it's a road, it is a toll. If it's a power line, it becomes like a tariff. So that is the income which comes here. So to that much extent, we are more, I would say, into physical, real infrastructure assets.
Okay. Well, very interestingly, you've told us how it's similar to a mutual fund and drew that analogy. But let's talk about what differentiates an InvIT in terms of risk, returns, regulations, taxability, and even liquidity. So let's say an InvIT vis-a-vis a mutual fund or vis-a-vis a fixed deposit or any financial asset. What sets it apart?
Let us try and see the difference sort of the thing. If you take an FD, a bank FD, which is very common, everybody knows about a bank FD. So they put their money for a fixed term, which they have in mind that they can spare the surplus for such and such period. So they go to the bank and say, I want to put money for 1 year or 3 years or 5 years. The bank gives a rate, which is the rate of interest that the bank will give for the investor for placing this money with the bank. Okay, so what does he do? He places the money, he gets periodical interest. And at the end of the period, he gets back his capital. So definitely the capital doesn't fluctuate. Whatever you give, get back the capital. And for the money that you are given to the bank has agreed to pay you an interest. And that comes every quarterly, monthly, whichever is the period you have agreed with that particular banking institution. If you then move to a mutual fund, you put the money. Again, you decide that, okay, this money, whichever I have put in this particular mutual fund, I should be able to get back this money after 3 years, let us assume. So you have given the money to the mutual fund for 3 years. And you have put that money in a scheme which actually utilizes this fund to buy equity shares of various companies. So they go and buy equity shares of various companies. So there's no periodical return which comes to the investor if it's an equity share. You can only see in the mutual fund that when you put the money there, the mutual fund scheme had, let us say, an NAV, net asset value of 100 rupees. And at the end of the third year, when you are taking that money back, you are seeing it is around 130. The 100 NAV became, net asset value became 130 net asset value. So whatever money you are given to them is appreciated. So you are getting back on 100 rupee which you gave to them, 130. So 30% return over 3 years. That is annually, if you take it in a simpler term, it is 10% yield you are getting. Because you are not getting any money in between. Third, you come to, let us say, a mutual fund only again, but they are investing in bonds. So at that time also, when you look at the bonds, they invest in bonds, AAA bonds or a AA bond for that matter. AAA is the rating which the rating agencies give for the underlying instrument. So they put that money there. Entry point, again assumption 100 was the net asset value of that scheme. Exit point 125, let us assume. So you got 25 rupees over the 3 year, at the end of the third year period. So 25% return for, let us say, for 3 years. Annualized, if you take it, it is 8.33% you got annually. Now you come to InvITs. So if you come to InvITs, what do you get? You actually give the money to the InvIT trust. The InvIT trust actually goes and buys let us say, a road project, a road which moves from Mumbai to Nagpur, the Samruddhi Expressway, if you are looking at. And what do they get? They get the concession right to actually levy toll on the traffic which moves through that road. So when they invest, they would have seen that, okay, there is a traffic which is there, and when they look at the documents which are being presented to them, they find that the rate of growth of traffic has been projected to be some 5% per annum. And if the traffic meets all those numbers, then they get a cash in that particular trust, and that trust has to compulsorily give back money to the investor on a half-yearly basis. The cash that they have, at least 90% of that cash should be returned to the investor. That 90% cash which is being given to the investor is out of net distributable cash. What is this net distributable cash? Net distributable cash is actually after meeting their expenses, like small maintenance of the road or paying the salary for collecting the toll, all those expenses are taken away, and balance what is remaining, 90% of that has to compulsorily come back to the investor. So though he has put it, let us say that project is for 30 years, that is that trust has the right to collect the toll for 30 years, his horizon might be 5 years. The investor's horizon might be 5 years. So the investor puts today, and for the next 5 years, he continues to get this money from the InvIT on a half-yearly basis as per regulation, but as per practice, quarterly they get their money.
Okay.
So let us say quarterly they are given back some money, and that money is received by them. And at the end of the 5th year, they withdraw the money by actually selling whatever they have owned in that asset in the stock exchange. So when they entered, they paid 100 rupees in the stock exchange, and when they are exiting, they got 110 only. So it is roughly around 3.33% capital gain if it is a 3-year. If it is a 5-year, let us assume it to be a 2% capital gain they are getting. So that 2% capital gain they are getting, plus periodical cash flows they are getting every quarter, if they add together, they get a return. That return is called the IRR, internal rate of return. Or in a bond parlance, it is called as yield to maturity, YTM in the bond. So they get that money back. That yield, if they work out, they get a decent return. So the decent returns could be anywhere ranging between 9 to 14%, depending upon which project they are putting. You asked me about what is the risk factors in the, let us say, we are putting it in various instruments. In FD, there is nothing like a major risk factor. You will get back your principal. There's no variability of principal. You get back your principal and you get back periodical interest. So not much risky. The equity mutual fund, its risk characteristic is dependent upon how the underlying companies in which these mutual funds are invested, or which sector. If it is a sector specific mutual fund, which sector companies they are invested. So depending upon that, there is a variability. So whatever money you give, you are not that certain to say that that entire principal will come back. Whereas in an FD, the principal will come back. So there is a variability which we actually call it as volatility. That volatility is linked to the way in which the equity market, like in an exchange, whether it is the National Stock Exchange or BSE, the equity shares are being traded. So that's a volatility. If we come to, let us say, InvITs, you don't see that volatility.
Okay.
The reason behind that is it is real asset. It is not a financial asset. So you will not see that much volatility in the way in which that investment works. Since we are not saying that it's not much volatile, so can we compare it to FD? That is the next question that we can ask. You can't say that it is comparable to the FD because there's no maturity period here. It is perpetual instrument. Whereas for FD you have a 5-year, 3-year, that sort of thing. So the maturity is actually a derived maturity where essentially the investor keeps in his mind that I have put it for 5 years. At the end of the 5 years, I will sell in the market. So that's how he is taking the derived maturity. In an FD, you get that whatever contracted interest rate, 8%, 9%, whatever, throughout that life of that FD. Here, there's no contract. Here you will get the distributions. That is, every quarterly you will get money. 90% of that net distributable cash flow you will get. So there is a variability. So on the distribution there is a variability. On the, let us say, the principal that you have invested also there could be a variability. But we have seen that the principal over the last 7 years track record that we have seen, we see that the principal doesn't vary to that great extent because it is not directly linked to the equity market. So the principal volatility will be much less. The distribution, there is a volatility in the sense depending upon how much traffic comes on the road, the toll collection also can vary, isn't it?
Yeah.
So because of that, that distribution is variable. But for that risk that you are taking compared to an FD, you get a higher return. So the risk-wise, if you are looking at it, there is definitely a variability compared to an FD, which is a basic instrument. So to a certain extent, it mirrors the equity structure.
Okay.
But the returns for that risk that you are taking, it is actually, I would say, a higher return for the risk that you are actually taking.
Interesting. But another aspect is that InvITs are required to distribute a significant portion of their cash flow to investors. Now, can you explain how these distributions work, what the 90% distribution requirement actually means, and how should investors assess this sustainability of this?
Okay. See, if you look at the way this instrument has been structured by the regulator, SEBI as a regulator, it is more or less mirroring the global way in which this sort of business trust actually works. So what is the risk for an investor? Let us look at it from the investor's point of view, because this show is for the investor. So let us look at it from the investor's point of view. The investor has invested some money and he is not certain when that money will come back. So as a regulator, what does the regulator do? Regulator says, I will reduce that risk for you by putting a regulation which is that whatever is the cash flow that project is generating, first use that cash flow for meeting the expenses to run that project. Balance whatever cash flow is remaining with you. The regulator is not permitting the InvIT to use it for their own another project. What he is telling is, whatever is that cash flow that you have, which is surplus for you, please give that surplus back to the investor at least on a half yearly basis. There also, in order to ensure that for the working capital purposes, for that particular project to run, which is a real project, he said keep 10% cushion with you, 90% you return it back to the investor. So the investor gets back the money 90% every quarter of the cash flow that project is generating. So his risk is actually getting reduced because he is putting some money, but he is actually getting 90% of whatever cash flow is being generated back to him. So if he is originally thinking that this is a 30-year road project, okay, so my investment is for 30 years, actually he would have recovered his original investment by this distribution in at least around 12 years. Baki 18 years, whatever he is getting is the bonus that he is getting.
Interesting.
So the risk is completely mitigated from the investor's point of view. And what are all the components of the distribution? That is what also we need to see. So essentially, the distribution can be of three components. That is whatever money the InvIT is giving to the investor. Let us say is giving every half year 5 rupees. Okay. That 5 rupees will have a portion which will be the dividend. That dividend is the return on capital. He is actually giving a return on the capital invested by the investor. So 5 rupees mean let us say 1 rupee he gets back as dividend. Yeah. Then this investor would have given part by way of equity, that is called the units in because it's a trust. A trust cannot have an equity share. Trust capital is called unit capital. That is same as mutual fund. If you look at it, mutual fund also it is units. That's why Unit Trust of India was born as the first mutual fund. It is called units. It's not called equity share capital, unlike a corporate entity. So that unit is the unit capital, and you would have also given some loan to that particular InvIT. So he gets, let us say, 2 rupees by way of return of capital. The 1 rupee out of the 5 rupee was a return on capital, which is equivalent to the dividend of any equity share, and 2 rupee is return of capital. That is the project is giving money back and telling this particular investor, you gave me 100 rupees, out of that now I have given you back 2 rupees. You can reduce 2 rupee from your original investment. And then balance 2 rupee could be return or interest on borrowed capital. If you had given some loan ka interest. So 3 components are there. One is the dividend component, which is return on capital. Second one is return of capital. And third one is interest on borrowed capital. Okay, that's how that distribution happens. So from a taxation perspective, we are looking at it. How does it help the investor? The return on capital which you are giving is actually taxed like a dividend. Okay. And interest which you are returning is taxed like interest income that you get on any debenture or bond. The return of capital, since it's a capital being given back to the investor, till this capital is going to fully wipe out the original investment the investor has made, he need not pay any tax. Okay. Let us assume 100 rupees he had invested originally, and he got that 100 rupee by 12th year. He got that 100 rupee by this periodical distribution. And 13th year, he gets some money. Here this investment, original investment he has made is zero now. But still he is getting money, which I said bonus. Now he is getting bonus for the next 30 years. That money is treated as capital. Yeah. So that is how he is benefited from the taxation perspective.
Okay. Let's say if somebody wants to invest in InvIT today, what are some parameters that they should evaluate before they deploy any funds into it? And Beyond your distribution yield, are there any other measures, like you said, there's IRR, there is YTM, there's
Yes,
cash flow,
yes,
etc.
yes.
So for InvIT also, is there anything?
See, any investment, let me try to explain it from the beginning. Any investment any person does, whether I do or you do or any other person does, he, according to me, should follow a basic principle called SLR principle. S stands for safety, L stands for liquidity, and R stands for return. So any investment you do, you please follow this principle, SLR. So if you take it from that angle, safety purposes, if you are taking, the InvIT is safe for the simple reason, what could go wrong? If you had invested in a company share, which is a basic infrastructure company only, why should he come to InvIT? He is investing in an infrastructure company. Then what happens? There is every chance that that infrastructure project may not be completed. So the project completion risk is there. Whereas if you invest in, let us say, an InvIT, because of SEBI regulations, this InvIT can invest only in operational projects. So here this project is up and running and it is generating cash flow. So to that much extent, the project completion risk is no longer there. So that is one thing he should look at. So here he is looking at the operational projects. Then second one is, let us say, he should look at the distributions which we had talked about, because that forms part of the return calculation, the total return calculation, or the equity IRR. That is what we can look at. It's an equity IRR. So if you look at that calculation, you will look at what you have invested, how much money you are getting by way of distribution, and how much money you got when you got out of in the stock market when you sold your unit. All put together, what is the total return you are getting and what is the net present value of that cash flow. That gives you an equity IRR. So you will look at that equity IRR. But in addition to that, we actually need to look at the quality of that distribution. We should not be carried away only by, let us say, initial 2-3 years, they get a lump sum figure as the distribution. Let us say he is investing in a project which is InvIT project which is 3 years already done, and he saw the past performance of, let us say, lump sum amounts coming as distribution, and he thinks that okay, lump sum will be there perpetually. That is one thing which he should look at. What is the sustainability of that particular distribution? So the quality, underlying quality of that distribution has to be seen. And where does he get that quality? The underlying asset that this InvIT is owning. Because this asset has to generate the cash, and that cash only will come as a distribution. So you need to do that due diligence also. You should not just get carried away by, let us say, an advertisement which says the XIRR is 12%. You should see whether this 12% I will get over his investment horizon, at least 5 years, 7 years, 10 years, that sort of thing. So that quality has to be seen. The second, that is on the return part. If he is more statistically minded, he can use quants. So one of the things that he can use is he can use the Sharpe ratio. There's the ratio called Sharpe ratio, which you actually use for evaluating any investment, whether it is an equity, mutual fund, anything. So what does that signify? That signifies, the Sharpe ratio signifies that for the risk that you are taking, whether the return that you are getting is actually optimal or is it suboptimal. So you can use that Sharpe ratio to evaluate any InvIT sort of a project, and that will also give you an additional confidence. We have seen from our sort of calculation for the risk that he is taking, the risk that he is taking is on volatility. For that volatility risk that he is taking, If you use the Sharpe ratio, you will find that he is actually getting optimal returns or above optimal returns and not suboptimal returns. So this is something which he can look at.
Are there any other principal risks that also investors should keep in mind beyond what you just flagged?
See, essentially, it is his investment. So he should first look at safety. Without safety, he should not touch anything. So you should look at the safety. So to that much extent, you should see which project he is actually investing, whether there is a near-term sight of how that project is going to function depending upon the economic factors, all those things, and also whether this particular InvIT has, let us say, a track record of keeping on adding more and more new projects into their InvIT. That ensures that that perpetual character of that instrument is protected, because new projects are always getting added. So the new projects will also give cash flow. So that cash flow will also be returned to this particular investor. So to that much extent, you should look at the pipeline of projects as well for this particular investment that is making. Then if you're looking at a rating as a perspective, I would say that regulator has clearly mentioned in the regulation that InvIT which has a leverage, borrowing more than 49%, he actually needs to have a AAA rating. So any InvIT, if we look at in the today's landscape, though as a system, InvIT's leverage has not crossed even 40% as a system. Individually, maybe some would have crossed 42, 43, that sort of a thing. So they are within the leverage norms specified by SEBI. So leverage is reasonably contained. So there's no issue. So you should see as an investor whether this InvIT is depending more on leverage or more on the unit capital that he is raising. So it's a capital structuring decision. Like let us say I am going to start a project, I can have a debt of 2 rupee for every 1 rupee of equity. That is called the debt equity ratio of 2:1. Okay. But in an infrastructure project, any infrastructure project for that matter, is capital intensive. So since it is capital intensive, depending upon which project the persons are implementing, the capital structure also changes. So generally it can even go up to 7:1. That is 7 times debt is to 1 time equity. The RBI also permits, the SEBI also permits. So that is something which he has to keep in mind when he is investing, whether the leverage is more and more or whether the leverage is within reasonable limits. If it is more and more, then you should probe which industry or which sector is this InvIT, and then look at the sector dynamics and see whether according to the sector dynamics, this particular InvIT should actually have that sort of a leverage. So that is one thing which you should do.
What is the one most common myth that you come across from an investor standpoint that kind of prevents them or obstructs them from investing in InvITs?
Generally, they are not invested in an infrastructure asset. A retail investor has not invested in an infrastructure asset. Even if you look at our own as a system, whole industry, our AUM is somewhere around 7,30,000 crore. Okay. But if you look at the percentage of investment made by the retail investor, it will be around 1.5 to 2%. So the investors are not aware about this product. But on a myth, since you are asking, I would say that essentially they look at the distributions that has been given by the InvIT and mistake it for the return. The distribution is not equivalent to the return. The return is different, distribution is different. And they think that it is like if you take a fixed income sort of the thing, this distribution is sustainable over the 30-year period. You know? it may be sustainable, it may not be sustainable. So that is something which they should sort of keep their eyes and ears open and see the quality of that distribution. So that is one myth which immediately comes to my mind.
So before we wrap up, I also want to understand if you have any message for investors who are already invested in InvITs or those who are evaluating it as an investment vehicle. Anything you would like to, any advice or anything on the way it's regulated, it's made transparent and accessible?
See, I will have to really thank the regulator. The regulator has done a wonderful sort of regulations. I would say on par or above par if you look at the global standards. For an investor, this is one of the safest investment that he can invest in. And if let us say that investors' risk appetite is actually moderate or low, then this is the best instrument that he can invest, because there's no other instrument having this low to moderate risk which gives a return which is substantial to the risk that this particular person is taking. So it actually suits the senior citizens, the people who want to actually build a corpus for their pension, that is the professionals and all those people. They don't get the pension, so they want a pension for the future. 30-year instrument, 40-year instrument, this is not available. This is one thing which is available. And if I compare it, I would say a 30-year Government of India security, if you are looking at it, today could give you an yield of somewhere around, say 7%. Let us take it as 7%, though it is marginally lower than 7%. So 7% if you take a Government of India security, where there is no default risk, you are assured of getting your principal, you are assured of getting that interest, because it is government of India. And you get 7%. And any corporate bond, if you are looking for a 30-year corporate bond, generally a AAA corporate bond actually is at a spread of somewhere around 150 to 200 basis points. For a longer tenor. For a shorter tenor, it will be only around 35 basis points. For a longer tenor, it could be at around 150 to 200. That is 7 plus 2, 9% yield. This gives you an yield of, InvIT gives you an yield of at least around 12 to 14. So for the risk that you are taking, you are actually getting a higher return than any other comparable instrument in the market, whether it is gold, whether it is real estate, whether it is, let us say, equity mutual fund. I would say this is one of the best instruments. People who realize it faster, they actually tend to gain faster. That is how it is. I know of a lot of individual investors who are actually managing their own treasuries, corporate treasuries. They have put their money in InvITs, realizing this potential for their personal investment. They have taken away money from FDs and put it here, because it is one of the very, very safe sort of the stuff. Then you might turn around and ask me, how is it possible that you are getting this? That is mainly because infrastructure asset class gives you a better return than any other asset class. So that way it is a very good thing. And counterparties to that asset class are generally government authorities. If it is road, it is National Highway Authority of India. If it is power, Central Electricity Regulatory Commission. So it's all government. So default also is not there. The worst of the time is 2016-17, though the regulation came in 2014, 2016-17 was the period when the first InvIT got listed. So 2017 to 2026, 9 years, which has a lot of events. One is the demonetization, the other one is the COVID. Despite all these things, the distributions have gone through without any major hiccup. So that itself gives you that confidence that this is one of the safer investment vehicle for a long-term objective that they invest in.
Wonderful. And on that note, we'll wrap it up. Thank you so much for sharing your perspective on the evolving role of InvITs in the Indian investing landscape. Thank you.
Thank you, Karinya, for having me in your show. Thank you so much.
And that's a wrap on this episode of Market Pillars Uncovered. If you found today's discussion informative, do like, share, and subscribe to Money TV. Remember, informed investing begins with understanding how investment products work, not just by simply following market conversations. And as always, Money TV will continue bringing you objective market conversations that help you find true value here. Until next time, invest smart and stay informed.